Hey there, welcome to Average Day Trader, where I teach you about finance and the stock market so you can make money. Today, we're going to talk about call and put options. So, let's get started. First question is, what are options? Options is a contract you can buy or sell, giving you the choice, but not the obligation, to buy or sell a stock at a specific price before a certain date. Think of it as if you are agreeing to buy it at a specific price, and the seller is agreeing to sell it to you at that price. From now until that time, the price can change. If the price increases, then you get to buy it at the lower agreed price, which will give you some profit because you can sell it at the higher price. Like they say, buy low, sell high. So, next question is, what are call options? We all know price can go either up or down, and you can buy an option depending on what direction you think the stock will go. If you think the price will go up, then that's when you want to get what's called a call option. So, for example, let's say you buy a call option that will expire in 1 month at the agreed price of $50. Then a week later, the price jumps to $70. Congrats, you have picked the right direction because you can execute the option to buy it at $50 and then sell it at $70. So now you've made profit. But if you don't want to buy and sell the stock itself, you can simply sell the option to someone else, since your contract is worth more than you paid for it at that time. Cool, makes sense. Next up is, what are put options? Put options is pretty much the same thing, but gives you the right to sell a stock at a specific price. This is what you buy when you think the price will go down. So, same example, you buy a put option 1 month out at the agreed price of $50. A week later, the price goes down to $30. Congrats, you get to sell at 50 even though the current price is $30. Another profit. So with that, you can either sell the contract or you can execute it. Before you can execute, you need to make sure you have 100 shares of the stock. If not, you have to first buy it and then you can sell it. Cool. Next question let's take a look at is, should I execute or sell my contract? One important thing to keep in mind is you can trade, meaning buy or sell options, as long as it's not expired. You can also execute it, meaning if it's a call option, then you can buy exactly 100 shares of that stock at the strike price and then own the stock indefinitely. Granted, you have the money to buy 100 shares at the strike price, but if the stock price is lower than your strike price, then it wouldn't make sense to buy at the contract price, since you can just buy it at the lower market price at the moment. In this case, you would just let the contract expire. For put options, if the market price is lower than the strike price, then you get to sell it at a higher price than it is now. But in order to sell it, you'd also need to make sure you own 100 shares of the stock per contract or have enough money to buy it at the lower market price and then sell at the strike price. So the other question we want to take a look at is, why do we use options? Well, people use it to speculate and take it as a bet, which can be profitable if you are correct. And especially if there's big changes in the price, then you're going to be even more profitable. But also, it's not just gambling. A lot of investors and businesses use it as a hedge, meaning to protect themselves in case of big moves that are unfavorable in the other investments. Say you have 1 million worth of Apple stock, and if Apple loses 10% of its value, then you are down 100,000. So in order to hedge that, you can buy a put option to offset your stock losses because you will be profiting if the stock goes down from the put options, but you will still lose from your stock value. But that will effectively minimize your losses since your puts are gaining in value while your stocks are going down. Cool. Now, the other question we want to take a look at is, are there risks? Yes. A few things to keep in mind with options is that options have an expiry date. So, a couple things that can happen. If you had hope for an increase in the stock price and it doesn't happen in that time frame, then you don't get the benefit. So, you kind of paid for the contract and you lose it, but you never get to really realize the benefits. Another thing is, if you don't know what you're doing and the stock goes the other direction fast, you can quickly find your options losing value. And in general, options will lose value faster than stocks. But say the stock doesn't really do anything, it just goes up and down a little bit. It just basically moves sideways. It's not really changing. It's just bouncing up and down. And then that's bad for you because options are great when there's large movements in prices, especially fast movements. That's when the contracts are worth more because it's more attractive, especially if it's going towards the right direction. And if it keeps going, then you are in good profit. I'm going to show you a couple scenarios and you guys can guess. First example is, this is what the stock chart is looking like. What do you think you're going to get? A call option or a put option? So if you said call option, you are correct. Since we are getting higher lows, then most likely it's probably going to continue. Not always, but just in general. Cool. So now you have the call options. What do you do with your call options? You're getting close to expiry. Do you sell it or do you convert it? What do you think you should do? So if the price keeps going up and you still have time in your contract, then that's great. You can either buy it at the lower price or you can just sell your contract for profit. Perfect. But what if this is what the stock market does and you've already bought the contract? Then what do? You still have the two same options. You can either sell it with a loss or you can execute it. But just remember, do you think it's a good idea to execute it? Probably doesn't make sense when you can just buy the stock at a lower price, but your contract is for a higher price. So do not execute. You can still sell the contract, take the loss, but still get some money back while you can. And there's still time on the contract. Cool. Next chart we'll look at is something like this. All right. And if you notice there's lower lows, then we can effectively think that it's going to continue going down. So we will be getting a put option here. Cool. So now if it continues going down, what can you do? You can, same options. You can either sell the put option or you can buy it. Granted, you have the money to buy it meaning the 100 stocks. But if you don't, then you just don't want to exercise it, or you maybe can't. Unless you already have 100 shares of that stock, then that's a different story. You could sell it. All right, now let's say this goes up. Then what do? Now you're in a put, but the stock goes up. Then that means that your contract is losing value. So you can either just sell the contract for a loss and get some money back. But do you think you should execute it? So you agreed to sell it at a lower price than what it is now. Do you think that would make sense? No, that would not make sense. Then you can just let it expire pretty much. All right, so call and put options, those are just basic options, but from that we can have advanced strategies where say the stock is just moving sideways, it's not really going higher than this amount or lower than that amount, then we can have a strategy where we are confident that it's just going to be in this range. Then if it's in that range, we can profit off of that. So there's a lot of ideas and a lot of option strategies, plays you can do. But for the most part, call and put options, you can do a lot with that, and that's probably all you need for now. All right, so without this video going for too long, I just want to say thank you guys. And just remember, I am the average day trader, and I hope you are also striving to be like me, but better than me is my hope. I want to make you guys better than me from everything I know and everything I learn from trading. So if you like this video, please like, subscribe, and I will come back with more videos. If you have requests, just let me know in the comments and I will come out with more videos trying to help you guys get better and learn more about investing, stocks, finance. Cool. With that, average day trader out.